This will be the most important video I record for 2022. Welcome back, everybody. If you're new, my name's Nicholas, and this is Investing Against the Grain. In today's episode, we're going to take a look at what some analysts are predicting for Tesla from a stock price perspective, and we're also going to watch a recent video released by Cathie that essentially gives proof, data, and statistics to what I've been saying for the last year with regards to Tesla and the auto manufacturer OEMs and what's going to happen moving forward. All right, this is going to be a revolutionary transition, and it's happening. We're starting to see all of the data points come across with regards to this. Make sure you stick to the end. Again, I would prefer it if you put it at 1.25, 1.5, 2x the speed. I think this is very important information. I want to make sure that it gets out to as many people as possible. So before we get into it, just so you guys know, we do have some new merch. If you can see it here, this is our Fremont, Shanghai, Berlin, Austin gear. You can find it on our shop. You can see the link down below in the description. We also have some other stuff. You can see one of our new models right here. But with that said, do me a favor, hit the like button, hit the subscribe button, ring that bell, and let's get into it. Let's start off with Goldman Sachs. Here you can see that they named Tesla a top stock pick for 2022, and they hiked their price target. Goldman Sachs raised their price target to $1,200 a share. Based on where Tesla is today, that's about a 15 to 20% upside over the next 12 months. So even if you don't believe anything I'm about to say moving forward here, that on its own merits is an amazing return over a 12-month period. Now, what we're starting to see is analysts realize what's happening with Tesla. I'll show you another one. Here we can see Morgan Stanley, the same thing, but this time Morgan Stanley has a $1,300 price target, essentially a 30% upside in the stock. Now, we're going to look more into Morgan Stanley, but first we have to set up the context for it. So in order to do that, we're going to start off by watching this video released by Cathie, and it's going to take a second, okay? We're going to talk about the used car market first, but it's very important because this lays the foundation for what's going to happen in the future, where this revolution is going, and how it's happening now, all right? And what I'm talking about is essentially the next iPhone to the world, okay? So what happened with the iPhone to the cell phone market, that's what we're talking about here. What happened with this huge transition, what Henry Ford did with the Model T, essentially, with the early vehicles, the assembly line, what he did to the horse and carriages, that's what we're talking about here. And it's happening. In this video, you're going to see it. So let's go ahead and get started.
Then we get to autos. I think this is the most fascinating part of what's going on in the economy right now. The Manheim Used Car Index has been screaming. I think the prices of used cars at their peak had increased on a year-over-year basis something like 60%. And that was adding to the CPI.
So for those of you who don't know, the CPI is the Consumer Price Index. I believe that's what it stands for. This is essentially how we as a nation measure inflation. So they'll take things like a vehicle, a used vehicle, and they'll compare the price this year to last year. And essentially the delta there could be what they consider the inflation rate. And so when she talks about CPI, just understand what she's really referring to is just inflation metric. It's not the best metric, and my explanation there is very high level of an explanation of what the CPI is. But I just want to make sure you understand what it is, at least on a high level moving forward here. But what she's saying here essentially is that the used car market essentially soared. We all know this. We've all seen it. We've all talked about it. We all have friends of friends who have sold their vehicles. So none of this is a surprise. None of this should be new for you. But this does lay the foundation for what we're going to talk about and where this revolution is really going to start to unleash itself.
Very interestingly, we've had a few reports now that suggest that the bubble was in used cars, and that it might be bursting. We can see this a few ways.
Now, I know that the thumbnail for this video talks about the bubble. I know I talked about it in my headline, and I've kind of alluded to it at the beginning of this video. The used car market is not the bubble I'm talking about. All right, again, we need to talk about the used car market because it lays the foundation for the real bubble and what's actually happening. So just bear with me. bear with this video. Again, 2x if you need to, but it's a very important that you understand this foundation because it lays the groundwork for everything else we're going to talk about.
On a year-over-year basis now, used car sales units are falling. They're down 4%. November to December, they were flat, but year over year, that was down 4%. We're seeing prices finally start to fall. They were down 1.2% month to month. Again, annual, that's a big decrease month to month. Annualized, roughly 12%. On a year-over-year basis, they're still up 46%, but they have started to fall. And what tells us that they will continue to fall, and mind you, they've had a disproportionate impact on the CPI. What tells us they will continue to fall is now an inventory buildup in the used car space.
So just to recap what she's saying there is that there's a huge demand for used cars, secondhand vehicles. And the reason for that was because we had the shortage of new vehicles from OEMs, the Volkswagens, the Fords, the GMs of the world, even Tesla. All right. There was a huge demand for vehicles, yet there weren't enough new vehicles. So what happens? So if there aren't enough vehicles to be sold from these OEMs with people looking for new vehicles, well, that's when these people who want a vehicle now look to the used car market. And in the used car market, people started buying those vehicles. And so what happened was you lost supply in that market. And so supply and demand, right? A lot of demand, higher prices. And so it was this inevitable reaction, right? OEMs couldn't make vehicles fast enough. They didn't have the resources. They didn't have the chips. All these foundries shut down. And so people went to the used car market. Well, the used car market started to get dried up and prices went up. Well, now what we're seeing is year over year, we see the used car prices start to decline, right? So now we're starting to see that inflection point of things starting to flatline, things starting to come down. So keep that in mind as we move forward.
Normal inventories for used cars are, I believe, 43 days. Now they are at 54 days, so well above average. And I believe at their lows, they were in the 20-day supply range. Now, many people are looking at the hike in used car prices, and they've probably been thinking about selling that car and that extra car maybe that they bought to avoid mass transit during the coronavirus. If they see prices coming down, they probably will move a little more quickly.
So in other words, because we're starting to see the supply build for used cars, right? The supply is building. We're not seeing as much demand for it. And what she's saying is that a lot of people are very aware of the fact that the used car market, right? People are able to sell essentially cars that they bought 2 years ago for the same that they bought it or more. And so as people start to see the prices for used cars to come down, some people who have an extra vehicle at their house that maybe they don't use because now they work from home, or people who just decide, hey, we don't drive that often, we really just need one vehicle, they're going to say, well, we might as well sell the vehicle now before this run up in used cars and those prices start to alleviate. And so what that's going to do is send even more supply to the used car market. We already see 50-day lead times or 50-day supply in the used car market, where Cathie was saying at its low, it was 20 days. On average, it's around 43, and now we're in the 50s. So we already have an oversupply, and we're probably going to get even more supply into the used car market. So as far as that goes, as far as the secondhand market, right, we're going to start to see that slow down and that come back to earth. But remember, the impetus for that, the reason it really started to go up is because all of these OEMs could not produce new cars fast enough, or they didn't have the supplies, they didn't have the chips, they didn't have the resources. So keep that in mind. Now we're starting to see supply build up for the used car market. So what does that mean?
And then on the wholesale front, this Manheim index says that inventory levels typically are 23 days. Now they are 33 days. So that's interesting on the used car front.
So now we're going to move over and talk about new vehicles. All right. So like I said, this whole reaction to the used car market was a result of new vehicles and not being enough supply for all the demand that was out there. So that demand, essentially cascaded over into the used car market. But now we're going to talk about new vehicles, the OEMs, and what's going on there.
On the new car front, fascinating. Uh, at an annual rate here in the United States, uh, new auto sales peaked in April at 18.25 million units.
Moving forward, remember that number. In April, 18 million vehicles were sold. 18 million new vehicles were sold. All right, that was at the peak. So that's going to be a very important number to remember in your head, 18 million in April, because it gives you context for what we're going to talk about moving forward.
Now, when we got to October and the auto OEMs were talking on earnings reports, each one of them, including Elon Musk, was saying, okay, the chip shortage is beginning to alleviate. Now, they had been blaming the decline in sales because it started in April and it was declined to 13 million units from 18 and a quarter. That 13 is an October number. Chips were the missing link. Okay, they're starting to be replenished. November, 12.86. December, we just got this number, 12.44. Meanwhile, you've got electric vehicle sales up nearly 100% at an annual rate. What's going on here?
So very interesting, right? We had in April 18 million vehicles, and it was nonstop. Everybody's saying it's the chip shortage. It's the chip shortage, and I'm not saying there wasn't a chip shortage. Okay, there was a chip shortage, right? Even Tesla, Elon Musk, they were saying it, but we saw it was a decline in sales from all these OEMs, essentially from 18 million all the way down to 13. But in October, unanimously, it's as if everyone got the same script. Every single CEO, and as Cathie says, even Elon Musk, said it's very clear that the chip shortage is starting to alleviate, right? It's starting to alleviate. We're getting more supply. We're starting to get the chips that we need to build the vehicles to sell. Now, what's interesting, though, is that in November, we continue to see decline. In December, that decline continued yet again. So the question is, why would this be happening? Why, if now we have all the materials needed, the chips needed in order to make these vehicles so that we could sell more vehicles, why aren't we selling more if we can produce more? That's an excellent question.
Well, it could be a combination of consumer sentiment not being happy about what's going on, and a consumer preference shift towards electric vehicles. That is why at the CES show, the Consumer Electronics Show, you heard these auto OEMs talking more about electric vehicles. Of course, it was the electronics show. And we saw that Ford's F-150 Lightning, that they were going to have to double production given all of the demand.
Now, this is something that we're all seeing, all right? You cannot watch a single car commercial that involves a vehicle that does not talk about electric vehicles. Everybody is transitioning towards electric vehicles, right? That's all the advertisement. That's all anybody wants. Yet, what's interesting is that anywhere I look, I see car dealerships all over, and they all have lots of vehicles on their lots, plenty of vehicles. So the real question is, if there are a lot of vehicles, then what's really happening here? And the first point that I've been trying to make for quite some time now is that sentiment has changed. People no longer want ICE vehicles. People want electric vehicles. This is no different, in my opinion, than what happened when the iPhone came out. All right. And everybody thought people were crazy. People thought Apple was insane, that nobody, and this was the bare thesis for the longest time for Apple, nobody was going to spend $1,000 on an iPhone. Nobody. Right? Why would I do that when I can pay $100 for this Razr or $100 for this BlackBerry Rim? Right? That was the thesis, that Apple would never be able to be competitive or have a big total addressable market at those prices. Yet consumers voted with their wallets, and consumers said, you know what, I'd rather sacrifice here, sacrifice there, save money to get the iPhone. And I think the same thing is happening now with electric vehicles. People are voting with their wallets. People are sitting there saying, hey, you know what? I'd rather save some money. I'd rather not go ahead and buy a ICE vehicle, even if it costs a little less. I'd rather save a little more money so I can get that vehicle that's going to stand the test of time and be a futuristic product, right? It's the newest technology. People will spend more money for new technology. Now, here's where the OEMs are really in trouble, for somebody just to change their mind. All it takes is a little child saying, "Mommy, Daddy, why don't you get a Tesla?" Right? We've seen all over Twitter, all over Instagram. We've seen all these little kids talking to their parents. Every little kid knows what a Tesla is, right? They just do. Right? I don't know how. It's like a cultural phenomenon. It's no different than what happened with the iPhone. It takes a person sitting in their friend's new Tesla and just going for one ride and experiencing it for the first time, right? Sentiment, it takes nothing. It takes a split second for somebody to change their mind and decide what they want and to move away from ICE vehicles. However, for the OEMs, they cannot pivot that quickly. So I think the first thing we need to talk about here is the sentiment. And I think that's a big thing that we're starting to see. We see it with the commercials. We see it with Ford announcing the new F-150 Lightning, saying that they need to double production, then they need to double it again, even though they haven't even made or sold a single one yet. We see GM doing the same thing, right? We see all this lip service, what we're seeing, yet we're not seeing the products yet. But why are we seeing that? Why are we seeing all this lip service from all these OEMs who aren't even producing these vehicles yet? Because sentiment has changed. This is what people want. People want electric vehicles. And this is a big problem for OEMs because they cannot make them yet. It takes too much time for them to pivot. But let's continue. Let's listen to Cathie.
Well, what they don't tell you during those appearances at CES and so forth is that electric vehicles make up maybe 2 to 3% of their sales, and that 97% of their revenue bases are gas-powered vehicles. And it's probably 90% plus of their production now.
So think about that. If 90%, 97% of all their sales, everything they make in revenue, of the entire production that they have currently now are ICE vehicles, and we have very clearly seen sentiment change where people want EVs, that means that ICE vehicles are now like the Blackberries, the Motorola Razrs, the Nokia Bricks, whereas Tesla's electric vehicles are the iPhones. This is a big problem for these OEMs because they have not produced these electric vehicles yet. They don't have the supply chain yet. They don't have the batteries. They don't have the manufacturing plants for this, right? They're still stuck in this world of ICE vehicles. So, this is not even a chicken and the egg. This is a matter of fact that sentiment can change very quickly. People's desires can change quickly. But for these OEMs to pivot, it's going to take a long, long time. And it's not even just manufacturing. It's not even just batteries. It's not even learning how to create an electric vehicle versus an ICE vehicle. But it's the bigger ecosystem, right? It's the software that runs the vehicle. The hardware is one thing, all right? The hardware is honestly even more trivial than anything. It's the software that matters. And then the supercharging network that matters, right? It's this whole ecosystem. They have to deal with the fact that Tesla doesn't need to deal with dealerships, right? That whole model, right? It just keeps compounding on top of each other. So this is a very big deal.
If there is the combination of the consumer turning off, not wanting to spend as much money, certainly not on big ticket items, and a preference shift, if they're going to spend, they're going to spend on electric, then these OEMs have an issue. They have a problem.
They have a big problem.
And we think we're going to hear more about it in the quarterly reports. And we hope analysts start asking about it.
So I don't know if analysts are going to start asking about it. And I don't even know if OEMs are going to acknowledge this during their quarterly report. Mary Barra just, for example, seems to be delusional and not wanting to admit that there's a company called Tesla, doesn't want to admit the fact that they do produce ICE vehicles, and that's the majority of where they make their revenue and what they produce today. She doesn't want to acknowledge the fact that, they made one Hummer EV in 2021 or had one sale. But what I do know is that Goldman Sachs is acknowledging Tesla and giving them a $1,200 price target. What I do know is that Morgan Stanley had this in their note, and I think this is very key for this pivotal switch where analysts are starting to see what's happening. So here we see in the note from Morgan Stanley where they say, while Tesla is not our top EV pick, which makes absolutely no sense, but they say while Tesla is not our top EV pick, it's arguably our most important stock pick. Not owning Tesla means not owning the one company that could make all other EV names obsolete. Look for Berlin, Austin, Gigapress, Structural Pack, many new models, intros, and other developments to enter the narrative in 2022. Now, you can read the rest of this here, but I think what's even more important is essentially this bolden text at the very bottom. So this goes back to what Cathie Woods was saying, all right? Listen to this. The market seems to believe that the shift to EVs will create more winners than losers, ... And the EVs are net positive for legacy auto firms. In other words, for Volkswagen, GM, Ford. We wonder when the market will begin to price higher EV adoption as a net negative for auto stocks, i.e. not a positive. Let me read that again. We wonder when the market will begin to price higher EV adoptions as a net negative for auto stocks. In other words, when more people are choosing to buy Teslas versus vehicles from Ford and GM, when's the market going to realize, hey, everybody's buying these vehicles from Tesla, GM and Ford, they don't have the production to sell the vehicles that consumers want because it's going to take them another year, 2 years, 3 years to even pivot to that. When's the market going to start to factor that in? The market hasn't factored that in. What the market has done so far is they've heard Mary Barra, Jim Farley, Herbert Diess, all these people make all these announcements about electric vehicles, and the market says, "Ooh, that's the next Tesla. Ooh, that's the next Tesla." Meanwhile, none of the revenue is really coming from these vehicles, and if they are, it's 2 to 3%, where the rest of their business is based on this obsolete technology called the internal combustion engine. So Morgan Stanley wonders, when is the market going to begin to price in the fact that higher EV adoption is a negative for auto stocks? This isn't a note from Morgan Stanley, which means that now analysts are starting to see this. They're picking up on what Cathie Woods is laying down, right? This is starting to happen. And so I don't know if these analysts are going to ask and question Mary Barra, Jim Farley, the Herbert Diess of the world about this and the impact this will have. But I think it's not going to matter because we're going to start to see ICE vehicle sales decline. We're going to see people decide to save and wait and spend a little more money to make sure they have an EV versus an ICE vehicle. It's happening. We see it. It's happening in numbers. It's happening with analysts starting to change their price target and make notes like this. But we're not done yet. Let's listen more to Cathie.
Now, I look at the performance of stocks like GM and Ford. They soared on those electric vehicle announcements. Think about that. That's ridiculous. It's only 2% of their sales. And what if the other 98% or so forth are on their way out as the consumer preference shifts toward electric? They have problems. They have problems because their gross margins, depending on the company, are somewhere between 10 and 20%. Those are very low gross margins. And if you look at the Bloomberg estimates for this year, 2022, after a very weak 2021, you see growth estimates in the 10, 15, 20% range. The US-based ones are at the higher end of that. Well, that may not happen. And again, they don't have a lot of room for error. And we have seen them pivoting and announcing that they're pivoting ever more quickly towards electric.
And this is undeniable, right? Everything we see from any of these OEMs, they just talk about what they're doing for electric. They don't talk about their ICE vehicles. All they talk about is electric. Yet, again, it's just lip service, right? They're trying to pivot, but it's going to take a long time for them to pivot. It's not going to happen fast, right? It's not just about putting a body into a new powertrain, right? It's about having to now vertically integrate everything, right? They have to go with the Tesla model. They're going to have to make their own batteries or partner with other manufacturers who are building batteries. They're going to have to learn how to make their own seats, how to create innovative ways of making motors that are more powerful and have more output, but don't blow apart because there's so much torque and right the material engineering that goes into this. The manufacturing, methodologies so that there's less bottlenecks, the improvements for drag coefficients, the fact that every single gram of weight matters in an electric vehicle. There's just so much to do. And we haven't even talked about the software. We haven't even talked about the network to charge these vehicles, right? It starts to stack up. And while sentiment can change in, again, the flip of a switch, These auto manufacturers can't do that.
But the problem is almost 100% of their base is going to go obsolete over time. And I'd like to end right now by talking through just one more thing, going back to autos and giving you a sense of where the bubble might be in this market.
Now, as I mentioned before, the used car market, that was not the bubble that I wanted to focus on. This is it, okay? You've probably been able to piece it together by now, but now we're going to talk about where the real bubble is.
Listen to this. I gave you the story about Ford reporting that it would have to double its electric vehicle production of the F-150 Lightning, and the stock just taking off, not paying any attention to the auto statistics I just mentioned. Well, when I think of what could happen in that space, and I see these stocks ramping on sales that mean nothing to these companies in terms of their earnings, shall we say, right now. In fact, they need to invest a lot more in electric to make it happen and to move the needle in these companies. But what if we're right and there is not a 20% increase in sales? Maybe sales are flattish year to year. That would put them at roughly 15 million units. And they'd probably have to start cutting prices if we're right on the used car market and the pricing there, which means they're probably going to be facing some credit issues since they're hugely leveraged to the credit that people take out on their autos.
So let's pause there for a second. Now, what she's talking about before, as far as, these valuations going up, Ford, GM, Volkswagen, right? They're all getting these crazy valuations. Even companies like Lucid and Rivian, they're all getting these crazy valuations of what they might do in the future, which is fair to a certain degree, right? But what's not fair is to try to price these companies as if they are going to have these sales done tomorrow. Okay, I mean, everybody wants to think that these companies are the next Tesla, and they're not. All right, they're not the next Tesla. Ford and GM and Volkswagen, Rivian, Lucid, they're all getting priced as if they're all going to be the ones putting out 300,000 vehicles next quarter. Yet they're not. Okay, so the real question is, where's the real bubble going on here, right? Like, where is it? And especially what's even more frightful for anyone is, you think Rivian and Lucid might be in trouble? Forget about them. Right? I don't think they're in that much trouble at all. I think the real trouble is with these OEMs because, again, everything they're doing right now, all the revenue, all the profits that they make come from these ICE vehicles, the segment that they need to take down in order to bring up the electric vehicles. And don't forget, it's not like they have a lot of room to run with because they have very low margins on this business. So there's a real problem here. And to even compound it, they have all of this massive debt, which Cathie's going to talk about now.
And as prices go down, residual values go down. And, auto credit was the best performing credit in 08, 09. And so there's a lot of complacency in that market. So we think that complacency is misplaced and that the auto credits out there could become a mess. So if I'm right on any of this, there will be disappointments in terms of the auto sector. And I wouldn't be surprised if at least one of the companies loses money next year, which would be most unexpected.
Let's talk about this credit, first of all. Let's talk about the debt that these OEMs have, because I talk about this every time I bring up GM or Ford. They have massive amounts of debt. They have hundreds of billions of debt. And it never fails. I'll get comments down below talking about, well, you don't understand their business model and they actually have value because of all the vehicles are sitting on lots and all this stuff. And what I think, hopefully you're starting to understand is that all of that is obsolete technology. That's like me telling you that I have $2 billion worth in assets in our, Motorola Razr phones that I just haven't sold them yet, but they have value. Well, no, they don't. The second that we got the iPhone, the value for those phones dropped. And as the iPhone gained in popularity and it grew in mass adoption, those razors quickly depreciated in value. And so imagine if these OEMs that have all this debt, what are they going to do when people aren't choosing to buy those vehicles anymore? What are they going to do when their entire manufacturing process is geared towards ICE vehicles? What are they going to do? See, at least Lucid and Rivian, they're startups. They're expected to lose money, right? They're expected to run a high amount of debt. That's why they go to the markets. They have that startup mentality. That's everybody expects that. But Ford, GM, Volkswagen, no, those are profitable companies at the moment. So people expect them to produce revenue, to produce a profit. So this is the inflection point, and this is what we're starting to see now. Again, secondhand car market, the used car market, that's starting to get oversupply. Why? Well, because people are changing their sentiment. And why did the secondhand market even gain all of this need and demand to begin with? Well, because we had a chip shortage, and so the OEMs couldn't produce vehicles fast enough. Well, now the chip shortage is essentially alleviated, yet they keep declining in sales for new vehicles. And the used car market is starting to see more and more supply and not as much demand. What could it be other than the sentiment has changed towards electric vehicles? The thing these OEMs don't have, the thing that's going to take a few years for these OEMs to even be able to produce. And meanwhile, these OEMs have quarterly results they have to show a profit for. It's this chicken and egg. And unfortunately, it's just the ball is going to drop on these auto manufacturers. So it'll be very interesting moving forward to see what happens. But I agree with Cathie. I think we're going to see some of them lose money and show a loss.
And if it loses money, what is that valuation? Where are the crazy valuations now? Are they in our stocks? Or is it in an auto stock where there might be losses? And what's that PE ratio? That's infinity. That's where the bubble is. And I think you're going to see a lot more cases in point as this year moves along, and the innovation that we see evolving so rapidly.
That is where I believe the bubble is. That is why I think it is so important. Again, none of this is financial advice, all right? So this is just me as an engineer telling you what I see, what I'm doing. And again, this is more so of me, giving advice to my future kids. And for my future kids out there, right? Imagine if you could go back to the day where the iPhone was created. One day I'll be saying, imagine if you could go back and invest to when, Tesla was only worth $1,000, $600, right? It's the same thing, right? We see it over and over. People always say, oh man, if I would have bought Google back in 2000, if I would have invested in Amazon in 2006, if I would have invested in Netflix, right? We see it over and over. This is that moment. And this is why this is such an important video for me to get out there, because I'm trying to get it out there as much as I can. This channel is about investing, right? Investing against the grain. And as you guys know, I'm all in on Tesla. But this is more than just Tesla. This is a bigger movement. Tesla just happens to be the leader and the first mover in this industry. But we're moving to an electric world, and it's going to happen a lot faster than people think, right? The adoption rates for new technology is happening faster and faster as the world evolves with technology. And I don't think it's going to be any different when it comes to electric vehicles. And I do think Tesla will own 20 to 25% of the entire automotive market. So the point of this video is to show you this, at least give you my perspective, at least show you my thesis for investing all in on Tesla. And keep in mind, bigger scheme of things, this is one segment of Tesla. This is just the electric vehicle side of it. We haven't even talked about energy. We haven't even talked about full self-driving. We haven't talked about Tesla insurance, right? There's all these other segments within Tesla. Tesla is not just an automotive company, right? They're a conglomerate of a company. So hopefully this helped show you what I've been trying to say for the last year, right? We're starting to see some data points come out that give validation to my thoughts that, I'm not saying all these companies are going to go bankrupt. I think at least one of them will eventually, but I think we're going to start seeing these companies become shells of themselves. We'll probably see some of these companies split up into two companies. You might see a Ford EV versus old Ford, and they might let old Ford go bankrupt and just run with the new Ford EV portion of the company. We saw that happen in the oil industry, just a few years ago. So that might be something that we see. But either way, we're seeing this movement. We're seeing this bubble in all these valuations for these companies that aren't producing these vehicles that investors are giving them, credit for. Yet Tesla just reported a record-breaking quarter, the most vehicles they've ever sold in a quarter, and they're down from where they were before they announced that record-breaking number. I think we're about to see a big move in Tesla moving forward. I think Tesla is extremely undervalued. If you don't believe anything else I say, at least listen to Goldman Sachs, at least listen to Morgan Stanley, where they think the stock has anywhere from 15 to 30% upside from here. Hope this was of some value for you. This is a very important message I want to get out there. I want to give my perspective, and hopefully, these these other people saying essentially what I'm saying as well, gives you validation enough to at least go do your homework. You should never just listen to me, never listen to some other YouTuber, never just listen to an analyst. Go do your own homework, go do your own research, right? Because at the end of the day, if you don't believe in the investment you're making, then what are you doing, right? You're just wasting your money. All right. I hope this was of value. I hope you enjoyed it. Thank you for sticking to the end. Don't forget, we do have some new merchandise, so feel free to check it out down below in the description. You'll be able to find our store there. I'll also link a copy of this full interview with Cathie Woods down below. She talks a lot more than just this segment. I just, clipped out the parts that were relevant to this discussion. But again, we're going to leave it there. Do me a favor, hit the like button, hit the subscribe button, ring that bell. I love you all. Peace.